Hello everyone and welcome to chapter 4. In this chapter we learn how to complete the accounting cycle. We have 4 learning objectives. In the first learning objective we talk about the worksheet, which is an optional tool accountants use to prepare financial statements. In the second learning objective we learn how to close our accounts. We learn what types of accounts need to be closed. We also will talk about post-closing trial balance. So this will be our third trial balance in the accounting cycle. In the third learning objective, we will talk about correcting entries. And lastly, in learning objective 4, we learn what a classified balance sheet is. As we learned in the previous chapters, this is our accounting cycle. We start with analyzing transactions. If you remember, analyzing transactions includes 3 steps. In step 1, you identify your accounts. In step 2, you identify the amount and the increase and decrease of the accounts. And in step 3, you translate increase and decrease into debit or credit. So that is analyzing the transactions. After analyzing transactions, in step 2, we journalize our transactions. And then we move on to step 3, transferring the data from our journal to our ledger. It is called posting. Posting journal entries means to transfer data, the amount of each account, into our ledger. Then we move on to step 4 and we prepare our very first trial balance, or it is also called as unadjusted trial balance. Then in step 5, we adjust our entries. In chapter 3, we learned about adjustments. We adjust our entries, and after doing so, we prepare our adjusted TB, which is our second TB in the cycle. Then we are ready to prepare our financial statements. So our financial statements will be prepared in step 7 after preparing adjusted TB. In this chapter, we learned that we can use Worksheet as a tool to prepare financial statements. Then, when we are done with preparing financial statements, we can move to step 8, which is closing entries. And after that, in step 9, we prepare our third trial balance, which is called post-closing trial balance. Okay, and then if need be, we can go ahead and create and post reversing entries. And then we move on to our next accounting period and the cycle starts over. So what is a worksheet? It is basically an optional tool that we use to prepare our financial statements. It's basically something like an Excel sheet having some columns and rows that helps us to easily prepare our financial statement. People may or may not use Worksheet. It is not mandatory, it is optional. And also it is not a permanent accounting record. It means that you do not report it to anyone. After you are done with your worksheet, you can throw it away. You can discard it and throw it away. Traditionally, it was like a huge paper that accountants used to prepare financial statements, but these days they are mostly computerized. Okay, let's see how a worksheet looks like. As you can see, the first column lists our accounts. All the accounts will be listed here. On the right hand side of the account names, we have our unadjusted TB, which basically lists the balances of our accounts, either debit or credit. Then we have the adjustment amounts. And after that, we have our adjusted TB. As we include the effect of adjustments on the unadjusted TB and we prepare the adjusted TB, then we are ready to go ahead and prepare our first financial statement, which is income statement. And after that, we report the balance sheet accounts under the balance sheet columns, debit or credit. So that's the whole idea of a worksheet. As you are done with your worksheet, as you prepare your income statement as well as balance sheet, you can go ahead and discard this file. You don't report this file to anyone. So here is an example of using the worksheet. Step 1, preparing a trial balance. We list our accounts here, all those accounts that report a balance. We do not report those accounts with zero balances. So basically here we are listing the ending balance of each account coming from our ledger. Here under the trial balance, we insert them. Of course, the summation of the debit column should equal to the summation of credit column. The next step, we go ahead and directly insert the amount of adjustments here. Remember, we have not done any adjusted entries yet. We are using worksheet. When we use worksheet, we do our adjustments on the worksheet first, and then we go ahead and journalize our adjusted entries. And after that, we calculate the effect of adjustments on the unadjusted amounts and we prepare adjusted TB. In the next slides, I will show you how we do that. So here, as you can see, I have highlighted two accounts, supplies and supplies expenses. Of course, supplies is an asset account. And supplies expenses is expense, obviously. Okay, let's see what's going on here. So on our unadjusted trial balance, we see that our account reports a balance of an unadjusted balance of $2,500. But at the end of the accounting period, we go ahead and see that, okay, $1,500 of that amount is consumed, is gone. Basically, it means that that amount should be reported as an expense now because we have consumed it. Therefore, we go ahead and insert the adjusted amounts here. 1,500 deduction from supplies. Since supply is an asset account, if we want to deduct it, we go with the opposite of normal balance. We credit it. Supplies deducted. And of course, double entry system requires us to at least use two accounts. Here, the second account is supplies expenses. We debit supplies expense because its normal balance is debit and we are increasing supplies expense. So adjustments are inserted here. Let's see how they are affecting the unadjusted balances. So as we can see, unadjusted balance was 2,500 debit, but the adjustment is 1,500 credit. Just like the way we calculated the ending balance of a T account, it's exactly like that. So we had 2,500 debit, now we are journalizing 1,500 credit. The net effect is $1,000 debit. So we go ahead and we put this number, $1,000, into the debit column of our adjusted trial balance. The same is happening for the supplies expense account. If you draw the T account here, supplies expense, we had zero balance in the beginning, but in the adjustment entry, we have added $1,500 to the debit side. The balance is, of course, now the ending balance is 1500. Debit. Go ahead and we put that amount in under the debit column. That's how adjustments affect our trial balance, and that's how we prepare our adjusted TB in a worksheet. Let's take a look at another example. Here we are looking at unearned revenue and service revenue accounts. The unadjusted balance of service revenue was $10,000. Let me draw the T account here. Service revenue, the unadjusted balance is $10,000. Okay, what's going on? $400 is reported under the credit column of adjustments. As we see, this $400 is basically a portion of our unearned revenue, which is now earned. So if I want to draw the T account of unearned revenue, we also had $1,200 under the credit side of unearned revenue. During the accounting period, we earned that a portion of that money equal to $400. So we deduct it, we decrease the balance of unearned revenue. The new balance of unearned revenue here is, of course, the difference between left and right side, $800. That new balance is the adjusted balance, which will be reported under the credit side of the unearned revenue. And of course, since the adjusting journal was unearned revenue 400 debit, service revenue 400 credit, you see that this was the adjusted entry. The 400 credit service revenue goes under the credit side of the service revenue. Now the new balance of service revenue is 10,400. Okay, this one also goes to the credit side of the service revenue here under the credit side. But as you can see, it is not 10,400, it is 10,600. The reason for that difference is because we have another adjustment here affecting the service revenue account, and that adjustment is in fact here recognizing new service revenue, which is journalized in another entry. So two adjustments have affected service revenue. And if I want to show the effect of the second adjustment, that would be something like this. 200 here, and therefore the final ending balance for service revenue will be 10,600 credit, and we report it under the credit side of adjusted TB. Next step is to use the adjusted trial balance column to prepare our income statement and balance sheet. To do so, we need to just take the balances, the adjusted balances of related accounts, and put them under the related columns here. As you know, the income statement reports revenues and expenses, and actually we deduct expenses from revenues, and the result is net income or net loss. Once again, as a reminder, revenue minus expenses. If revenue is more than expenses, the result is net income. But if expenses are more than revenues, the result is called net loss. So since revenues and expenses are those accounts reported under income statement, we go ahead and find those accounts at the left side of the worksheet and transfer their balances. Service revenue is the first one. All the other expense accounts will also be transferred to the income statement column. It is important to note that revenue account. In this case, we have only one revenue account, service revenue. But in some cases, it could be more than one line. Nevertheless, the service revenue amounts, adjusted amounts, will be transferred to the credit column, and all the expenses will be transferred to the debit column of income statement in the worksheet, because expenses have normal balance of debit and service revenue or revenue has a normal balance of credit. Okay, that is it. Then we sum them up. This is the summation of all the expenses, and of course 10,600 is the summation of all the revenues, in this case only one line. We used to see that debit column is equal to credit column, right? In all cases, as you can see, debit column is equal to credit column. But here, we don't see that. Here, there is a difference between debit column and credit column. We will talk about that. It is okay to see a difference. Actually, in most cases, we expect to see a difference here. We will talk about that in a second. But before that, let's also transfer our balance sheet accounts to the balance sheet column as well. And then we move to our next step. So as you can see, the balance sheet accounts, including assets, cash, supplies, equipment, prepayments, payables, they are all balance sheet accounts, right? Under the balance sheet, we report assets and liabilities plus equities. So all these account groups, all the accounts included in these groups will be transferred based on their normal balance side to the balance sheet columns. Again, you add up the summation, you add up all the items, and the summation will be reported at the bottom. Once again, we see a difference between the debit column and credit column, which we will talk about them in a second. So that's how we transfer our numbers from adjusted TB to income statement and balance sheet column. Income statement reports revenues and expenses accounts. Balance sheet reports assets, liabilities, and equity accounts. Next step is to calculate the net income or net loss amount. Let's take a closer look at this portion of our worksheet. We learned that there's a difference, there could be a difference between the summation of debit column and credit column of the income statement. That difference is actually our net income or loss. Remember, under the income statement format, we report revenues and then we deduct expenses, and the result is net income or loss. Mathematically, it is revenue minus expenses, and the result is net income or loss. So the credit column reports our revenues, and the debit column, all of them, debit column reports our expenses. So here revenue is 10,600 minus 7,740, and the difference is 2,860. This difference, of course, revenue is more than our expenses. This is a positive number, which means it is net income. This difference is our net income, and we add it under the debit column to balance our debit and credit columns. Okay, so we put the difference to make our debit and credit column equal. If instead of net income we had net loss, the difference goes under the credit column. And that makes sense, right? Because when we have net income, it means that our expenses are less than our revenues. So the difference goes under the debit side to make things equal. Okay, and vice versa. It is important to note that as we calculate the difference between debit and credit column or expense and revenue column, and we put that number to make these two columns match, we also need to put that number under our balance sheet columns. But if we have net income, that difference goes under the credit side of the balance sheet. Okay, it is the opposite of income statement. Again, it is quite intuitive to understand why it is like that. Let's start with accounting equation, which is assets equal to liabilities plus equities. I'm going to expand the equity to common stocks plus retained earnings. And as you remember, we can also expand the retained earning to report revenues minus expenses minus dividends, right? I'm going to rewrite this line, and in this case, since we have net income, call it net income. Okay, so if we have net income, a positive number, net income here increases retained earning and eventually increases equity. And equity is under the credit side of the balance sheet. See how it works? So when we have net income, we put that number under the credit side of the balance sheet, and vice versa. If we had net loss, that number goes under the debit side of the balance sheet. As you can see, the first thing that is important to note is that we start our income statement by the name of the company, then the name of the statement, in this case income statement, and then the period of the data reported. Income statement always reports a period of time, not one specific date, but a period. So in this case, it is reporting the information related to the month, 1 month ended October 31st, 2019. As you can see, revenues come first, expenses are reported next, and the summation of these expenses are reported under the second column where revenues are reported. And the difference between these two goes to the last line, which is net income or loss. Of course, remember, presentation is important. The format is important. Having two columns is important. You report the total amounts on the second column. You report the components of those total amounts on the first column. Also, the final number should be double underlined. You already are familiar with the format of retained earnings statement. This statement also reports a period of time. Okay, in this case, again, the same month. We start by the beginning retained earnings. In this case, it is 0 because this is probably the very first month of the operation of this company. And then we add net income, revenue minus expenses. Okay, net income, and we deduct dividends. They are all reported under one column. They don't have any components. And finally, the last line is double underlined and it reports the ending retained earnings. Okay, so basically the formula here is beginning retained earnings plus net income minus dividends equal to ending retained earnings. Of course, if we had net loss, then it should have a minus sign. And this is a standard format of our balance sheet, just like the other ones, started by the name, the title of the company, the name of the statement, in this case balance sheet, and the time or the period. Balance sheet is the only financial statement that reports a point in time, one date, the last day of the accounting period. We start by assets. So far we learned that balance sheet reports assets on the left and liabilities and equities on the right. Yes, that is one way to present balance sheet, but there's another way which you report assets at top and then liabilities and equities at the bottom. We see the same format here. Assets are reported here, the total asset is here, and then liabilities as well as equities together, they are reported here. Of course, just like the side-by-side format, here the total amounts should match. Then after you're done with the financial statements, you are ready to go ahead and journalize your adjusting entries into your accounting system from what you had in your worksheet. Okay. Again, remember when you're using a worksheet, the order is preparing worksheet, then preparing financial statements, and then go ahead and journalize your adjustments. So basically, up to this point, there is no journal entry recorded in your accounting system when you're using worksheet. In learning objective 2, we talk about closing entries and our third TB, which is called post-closing trial balance. Closing is a step that we need to do to make our accounts ready for the next accounting period. We close only our temporary accounts. Permanent accounts will not be closed. But what does closing exactly mean? Closing basically means to empty out the balance of an account. Okay, you may think of your account as a bucket containing some water, for example, and then when you want to close your account, you go ahead and empty that bucket and make it ready for the next accounting period, ready to pour new amounts of water into that. That is called closing an account. We do not close permanent accounts. Permanent accounts keep their balances. They move their balances to the next accounting period. All the asset accounts, they are permanent accounts. All the liabilities are permanent accounts. All the equities are permanent accounts, except for dividend. Dividend is actually the only equity account that is a temporary account. We have to close it. We have to empty its balance. Other temporary accounts are all the revenues and all the expenses. So basically, all the income statement accounts plus dividends are temporary accounts. The other accounts are all permanent accounts. Closing entries make the balance of revenues, expenses, and dividends equal to 0. Closing entries transfer the balances of revenues, expenses, and dividends into retained earnings account. So once again, the purpose of closing accounts is to transfer the balance of revenues and expenses as well as dividends into retained earnings account. Retained earnings is a permanent account. It keeps the balance of all revenues, expenses, basically the net balance of all revenues, expenses, and dividends, and move them to the next accounting period. If you still don't know what accounts are revenue accounts, what accounts are expenses accounts, what are the asset accounts, what are the liabilities, you may refer to this sample chart of accounts. This slide is your best friend. This table is your best friend in this course. All the asset accounts are listed here. All the liabilities are listed here. Of course, this list is not comprehensive. It does not include all the accounts. Every company has its own list of accounts or chart of accounts, but this is just a sample chart that shows the most common accounts under each account group. Revenues and expenses are called income statement accounts. Equities, liabilities, and assets are called balance sheet accounts. Temporary accounts are all revenues and expenses as well as dividends, which although is part of the equity group, needs to be closed. Its balance should be emptied out at the end of each accounting period. Okay, now let's see how we technically can transfer the balance of our temporary accounts, expenses, revenues, and dividends, into retained earnings account and close them. We expect to see a debit balance at the end of our accounting period for expenses, right? Because their normal balance is debit. We also expect to see a credit balance at the end of our accounting cycle for revenues. Dividends normal balance is debit, so we also expect to see a debit balance for dividends. So those are before closing balances. When we want to close them, we go ahead and put the same amount under the opposite side of the account. If we are going to close an expense account, we put the same amount under the credit side. By doing so, the balance will be gone. The balance is now 0. Of course, double entry system requires us to use at least another account. That account, in this case, is called income summary. So we put the same amount to the debit side of income summary. In a second, I will show you the journal entry for closing expenses and revenues. But for now, I just want you to focus on the name of accounts and the sides, debit or credit. When we want to close a revenue account, revenue has a normal balance of credit here. We go ahead and put the same amount under the debit side. By doing so, the balance is gone. The balance is 0 now. So revenue is closed. Expenses were closed. And the same amount goes under the credit side of income summary. What's going on here? We transferred the expense balance as well as revenue balance to one single account called income summary. Okay. The balance of the ending balance of this account, income summary, is basically equal to the difference between debit side and credit side, right? But hey, debit side is our expenses, credit side is our revenue. The difference between these two is our net income or net loss. See how that works? Then the difference, whatever side is bigger, the difference goes to the retained earnings account and remains there. That's how we close our expenses and revenues. We use the same approach To close dividends, the only difference is that to close dividends, we do not use the intermediary account of income summary. Dividends balance directly will be closed to retained earning. Okay, that was the theory. Let's see how it works with some numbers. Here we can see that to close service revenue, we had $10,000, $400, and $200 altogether equal to $10,600. That's our revenue balance, ending balance before closing. To close this account, we need to put the same amount under the opposite side, debit side in this case, and by doing so, debit and credits are equal and the balance is now 0. And we put for the second account, we put the same amount under the credit side of income summary. Again, in a second, I will show you the journal entry to do so. But let's also finish the process for other accounts as well, and then we go ahead and see the journal entries. To close expenses, we had $1,500 supplies expense, we had $40 depreciation expense, and so on and so forth. To close them, we take these numbers and put them under the opposite side of the account. By doing so, balances will be gone, as you can see. So all the expenses are closed. The summation of all these expenses in this case is 7,740, which goes to the debit side of the income summary. Okay. Next step is to close income summary itself. To do that, we go ahead and calculate the balance of the income summary. In this case, 10,600 on the right side, credit side, and 7,740 under the debit side. The difference is, or the balance is 2,860, which goes to, for a second, forget about these lines here. Forget about these lines here. We are going to calculate the balance of income summary, 2,860. Okay, that's the current balance before closing. Now we go ahead and close income summary. To do that, we need to put 2,860 under the opposite side, debit side here. So we do that, and now both sides are equal and the balance is gone. Of course, we cannot do it. We cannot do any journalization on only one account to close income summary. The second account is retained earnings. So as with debit income summary, we have to credit retained earnings, and by doing that, we basically are transferring the difference between revenues and expenses to our retained earnings account. Lastly, dividends, we had $500 before closing balance. To close the dividend account, we put the same amount under the opposite side. Dividends balance is 0 now, and the second account is retained earnings. Dividends will be closed directly to retained earnings. Dividends do not use income summary account. And here we can see the journal entries. Let's see, for example, how service revenue is closed. As you remember, service revenue had a before closing balance of 10,600 credit. So here, this journal entry, this line here, we see that we are debiting service revenue 10,600. Balance is 0. Service revenue is closed, gone. And the second account, of course, double entry system requires us to have at least two accounts in every single journal entry. We close service revenue to income summary. The second account is income summary. Of course, because revenue was debited, income summary has to be credited. The same applies to the expenses accounts. Expenses, all of them one by one, if you remember, had some debit balances, right? Debit balances. Here we are crediting them one by one. We are crediting them and therefore we are closing them. The balance is gone. The summation, of course, goes to income summary account again, as we saw previously. In step 3, we close income summary itself to retained earnings. In this case, income summary is debited because we had a credit balance. Income summary had a 10,860 and then 7,740. The balance before closing was 2860. Okay. In this case, since the credit side is more than debit side, the income summary balance is credit and we have to debit it to close it. Okay. But in other cases, when we don't have net income, if there is a net loss, then the closing entry for income summary is reversed. Lastly, the dividend account is directly close to retained earnings. Dividend has a normal balance of debit. 500 is credited by doing so. Dividend has a normal balance of 500 debit. By crediting it, the balance is gone. Dividend is closed and the balance is directly transferred to retained earnings account. After we closed our temporary accounts, we prepare our post-closing trial balance, the third TB. The main difference between post-closing trial balance and adjusted trial balance is that, you guessed it, there is no expense or revenue account here. They are all summarized into retained earnings account. So retained earnings contain the net balance of expenses, revenues, as well as dividends. So post-closing trial balance simply reports all the permanent accounts, not temporary accounts. In learning objective 3, we review the steps in accounting cycles, but more importantly, we learn how to prepare our correcting entries. That is the main subject of this learning objective. So once again, real quick, let's go over the steps in our accounting cycle. The first one is analyzing business transactions. Here we need to take 3 sub-steps. First, identify your accounts. Is it cash? Is it account receivable? Is it revenue? Is it expense? Is it dividend? What account is involved in this transaction? In step 2, you identify which account is increased or decreased and how much. And what's the value, what's the amount. And in step 3, you translate increase and decrease into debit and credit. And then you move to the next step, which is to journalize your transactions. You list your transactions chronologically or based on the time, in order of the time. Next step, You transfer the amounts in your journal into ledger. You post those amounts into your ledger. Your ledger categorizes all the amounts based on the account names. It means that assets come first, then liabilities, then equities, then revenues, and at the end, expenses. These two are income statement account groups, and these three are balance sheet account groups. After posting the amounts into our ledger, we calculate the ending balances of each account, and ending balances will be transferred to our first trial balance. In the next step, we basically journalize and post our adjustments. In this case, we are not using worksheet. We are directly journalizing our adjustments. Then the adjusted balances will be used to prepare our adjusted TB. That's step 6. Next, we prepare our financial statements. Once again, in this order, we are not using worksheet. We start by preparing income statement. Net income from income statement goes to retained earnings statement, and ending retained earning amount from retained earnings statement goes to our balance sheet. In step 8, we journalize and close our temporary accounts. As you remember, revenues and expenses use income summary as an intermediary account to close our temporary accounts. Dividend is also closed directly to retained earnings account. And finally, we prepare our post-closing trial balance. Post-closing trial balance, which lacks the revenues and expenses and dividend accounts, does not include those accounts. Next topic talks about correcting entries. We are all human beings. We may make mistakes, and it is okay to make mistakes. It is the same in accounting. In accounting, it is okay to make mistakes. The thing that is not okay is to not fix and correct your mistakes. So here in this part, we learn how to correct our mistakes in accounting. If you don't make any mistake, you do not need to journalize any correcting entries. So if you're free of errors, then this step can be avoided, can be skipped. But if there's a mistake, we have to correct our mistaken submissions. When do we do that? Whenever we discover an error, we journalize a correcting entry. As soon as we realize that something is mistakenly recorded, we go ahead and correct it. We do not wait until the end of the accounting period. This is important. So as soon as you see an error or a mistake, you go ahead and fix it. You don't wait. And of course, you do all the corrections before you close your temporary accounts. So let's read this transaction together and see what is wrong here. On May 18th, the company purchased on account equipment costing $450. The transaction was journalized and posted to the ledger as a debit to equipment. So far, so good. $45. So here we see that the amount is not correct. The amount should have been $450. And the credit to accounts payable, again the accounts and the side is correct, but the amount is again wrong. So the mistaken journal entry was exactly like this: equipment 45 debit and accounts payable 45 credit. This is the incorrect entry. It should be something like this. The amount should be 450. How to fix this? First, let's see what's going on here. So we have the equipment account and we have accounts payable. The incorrect entry put $45 debit under the equipment, $45 debit under the accounts payable. But in fact, assuming that there was no beginning balance, the balance should have been 450, right? To fix that, we simply go ahead and put the difference. Journalize the difference, $405. By doing that, $405 plus 45 initially and mistakenly recorded amount, together they give us the correct balance, again assuming there was no beginning balance. It is the same for accounting, and it is the same for accounts payable. So this correcting entry plus this mistake together, they are actually equal to a correct entry. That's one example of a mistake. Another example is when we use the correct amount but wrong account names. Let's see what's going on here. On May 10, the company journalized and posted a $50 cash collection on account from a customer as a debit cash collection, debit to cash, correct so far, $50, correct amount. Okay, so this part is all good. And a credit to service revenue, $50. The amount is correct, but service revenue is a wrong account here because it was a collection on account. When you see the term on account, it means either accounts payable or accounts receivable is involved. Okay, on account, when you see that, it means either accounts payable or accounts receivable. In this case, we are collecting money in exchange of some accounts receivable. We are receiving money, right? So that is not an accounts payable. Of course, it is not a service revenue as well. The company discovered the error on May 20 when the customer paid their remaining balance in full. Let's see what was the incorrect entry. Cash debited, service revenue credited. What the correct entry should have been: cash debited, same amount, correct amount, but accounts receivable should have been credited, not service revenue. How can we fix this error? So the way I prefer to analyze these kind of transactions is to draw the T accounts. So here I have cash, I have service revenue, and I have accounts receivable. The incorrect entry puts $50 here, $50 here, and nothing under the account receivable. This one is okay. We are not worried about that because the correct entry, as you can see, gives us $50 debited cash. But this one is wrong. Service revenue is wrong. In order to fix that, we need to get rid of this additional balance, this addition to service revenue. We have to get rid of the balance just like that. So we go ahead and debit service revenue. By doing so, $50 on the credit side, $50 on the debit side, balance is gone. And we basically now credit accounts receivable because that is what it originally should be. Okay, so by this correcting entry, service revenue is now gone. Take a look. In the mistake, service revenue was credited. Now in the correcting entry, service revenue is debited. So together they cancel each other out. But there is a second approach to correct our mistakes. Before I talk about that, I want you to pay attention to two terms. Correct entry is different than correcting entry. Okay? Correcting entry is what we do to fix our mistakes, but the correct entry is what the entry should be. So make sure that you do not use these terms interchangeably. Okay, but what is the second approach to fix an incorrect entry? Let's take the same example here. This is our incorrect entry, the mistake. The second approach uses something called reverse entry, and it simply is nothing but taking your mistake here and reverse the debit and credit side. So here I'm going to reverse it, reverse entry, and I take whatever was credited, service revenue, I debit it, and I take whatever was debited, cash, I credit it. Okay, now it seems that I'm starting over. Why? Because the mistake was cash 50 debited, service revenue 50 credited. Now by this reverse entry, I am cancelling out the effect of whatever was originally submitted. It is now gone. Left and right are equal. And then now I am ready to journalize the correct entry. In learning objective 4, the last learning objective of this chapter, we talk about classified balance sheet. We already know that balance sheet reports the information at a point in time. All the data is presented as a snapshot at a point in time, which should be the last day in our accounting period. The other financial statements are not like that. Income statement, retained earnings statement, and cash flow statements are not like that. They report a period of time. We also learned that 3 account groups are reported on their balance sheet: assets, liabilities, and equities. In this learning objective, we learned that these account groups can be classified, can be categorized into some groups. For example, assets can be categorized or classified as current assets, long-term investments, fixed assets, or property, plant, and equipment, also known as fixed assets, also known as P, P, and E, also known as long-lived assets, as well as finally intangible assets. So these are common categories under the asset section. Under the liabilities, we do have current liabilities, long-term liabilities, and equities as a separate group. This is how we present different classes or categories of our account groups in our balance sheet. We start with current assets. Asset section starts with current assets, and then we report investments, then we report our fixed assets, and finally at the very end we report our intangible assets. You may ask, okay, where are the other ones, liabilities and equities? Well, they are here. So basically in this slide, I'm just showing the asset section of our balance sheet. This is the order. Order of course matters. It is important to report intangible assets at the very end and current assets at the beginning. Under the current assets, the first asset is always cash. Cash comes always the first. Within current assets, again, there is a rule to define what kind of assets comes first. the keyword is liquidity. Okay. The most liquid assets comes first and the least liquid assets goes last. Under the liabilities, again, just like assets, we start by reporting current liabilities first and long-term liabilities next, and at the end, we report equities. Again, the order matters even within the equity section. But I didn't talk about the differences between current and long-term liabilities as well as current and long-term assets. Current assets are those assets that can be converted into cash in less than a year or the operating cycle, whichever is longer. And long-lived assets or fixed assets are those assets that their useful life is more than a year. In case of liabilities, current liabilities are those liabilities, those obligations that you have to pay off in less than a year, and long-term liabilities are supposed to be paid off in more than a year. Under the current liabilities section, we always start this section with notes payable first, accounts payable follows notes payable, and then the rest should be sorted based on the magnitude of the amounts. Bigger amounts come first. And finally, under the equity section for a corporation, we always start with common stock account and then retained earnings. These two accounts are used only if we are reporting for a corporation. Sole proprietorship firms as well as partnership firms, they use capital accounts, not common stock and retained earnings. So the presentation is different depending on the types of the business.